Have global stock markets bottomed? After another good week last week and a sustained period of upwards momentum for the markets, of course with impending earnings season ahead of us, there is the question about have we seen the bottom and is the worst of it behind us after what's been a tumultuous start to 2022? Today we're going to discuss this, but of course nobody has the definitive answer. There's two schools of contrasting thought, with one side having the discussion surrounding perhaps we've priced in the worst of it. Maybe we've started to price in potentially a mild recession. We've obviously seen the multiple that the market's willing to pay start to come down. And yes, maybe the worst is behind us. While on the other side, there is a school of thought that says we haven't seen the worst of it yet. There's still a significant amount of uncertainty on two different fronts. Of course, we've seen valuations come down on the price front, on the multiple level, but we haven't seen the worst of the hit to earnings yet. And additionally to that, there's still macroeconomic uncertainties that may continue to evolve, that may continue to worsen, and how will the Federal Reserve and other central banks go navigating that soft landing with sustained inflationary pressures throughout the economy? It's a fascinating discussion. We're going to unpack it all. Sit back, relax, and enjoy. And so I thought this was a fascinating article that came out over the weekend in Bloomberg that really explored both sides of this discussion. It's called Broken Bulls, Big Breadth. Definitely recommend you having a read through. But I thought we can pull out some of these key points here and use this as a bit of a launching pad for our own discussion. So of course, at the start of the article, as we always know happens, like clockwork, a few decent days with stocks moving higher, out comes the charts. Have equities bottomed? Are we starting to see a more sustained rally? Or potentially, is this just the bull trap and another counter trend rally? We know we've seen a few different attempts at upwards momentum over the past 6 months that haven't been sustained yet. Having a look at what some of the discussion is. For the bulls, there's the third week in 5 for small caps. As we know, traditionally, small caps lead into the downturns and then traditionally are those initial signs of strengths on the way out. Signs that ETF buyers have become healthily demoralized. So this is more of a contrarian indicator on that front. Measures of market breadth expanding in ways that have signaled further gains in the past. There is a really interesting indicator that they outline in this article that I hadn't actually heard of before. And we'll talk about that later in the video. I'll be keen to know if you have. Well, roughly as many features of the latest rally were present in those that fizzed earlier in this year. This one has now outlasted all of those, even with Friday's hammering. And we saw on Friday there was a couple of weaker results. We know earnings season is just starting to pick up pace. This week's the big one, but Snap last week sent some shocks and some uncertainties throughout the social media space. And so easily the most debated topic for traders remains the state of corporate earnings. This is what we were talking about. Uncertainty over which put prices in a frenzy all year. We've actually got a video on the channel, but if you haven't seen that yet, of course, we talked about the fact that, yes, the valuations have come down mostly on the price and multiple side. But of course, price to earnings have two different components. Earnings so far have been relatively resolute. However, if we see a bigger hit to earnings, that could spell some uncertainty and trouble for the market too. So straightforwardly, the news this week was bad, with estimates for future profits taking lumps as companies disclose results, which obviously we just spoke about. But even that trend can be claimed as a victory by a certain type of bull who's viewed optimistic forecasts as a barrier to volatility winding down. Because ultimately, some people have stated, some analysts and economists have said that potentially we might need to see that flush out or that washout, the real capitulation style sell-off, which could be driven by downgrades in terms of earnings before we can start to see a bottom. And we can see here Adam Sarin, founder and CEO at 50 Park Investments, who nevertheless describes himself as increasingly bullish. However, it's still a fragile rally. We can see here this chart that Bloomberg provides. So in the yellow is the previous rallies we've had to start 2022. As we know, it's been one of the swiftest sell-offs that we've had in recent memories. So at the back end of that January period, run up, March, May, run up. However, this has been the most sustained in the green here. Over a month now worth of gains. And what is noticeable as well is they've overlaid the 10-year Treasury yield on this. And during this entire year, we've had rising yields, rising yields, rising yields. This is the first rally that we've had, black here in the S&P 500, that we've actually had declining yields, which is a very fascinating one. Of course, we know that we've seen yield curve inversion occur. We've started to see the short end climbing as well ahead of the 10-year. And the question is, what is the central banks going to have to do to bring that inflation down, and how heavily is it going to curtail or hamper growth? But of course, it's just a fascinating discussion on that front. Stocks survived a bruising final session to advance this week. Slew of disappointing corporate earnings. We talked about Snapchat. There are a couple of others out there as well. Weak data on business activity worldwide. And this was the indicator that we were talking about before. So Tuesday marked the second session in 3 that the market volume on rising stocks topped falling ones by a ratio of at least 10 to 1. Double breadth thrusts is what the phenomenon has been coined by Ned Davis Research. So essentially what that's saying is stocks that were rising, so all of the stocks that were rising in the market was rising by 10 to 1 in terms of volume compared to stocks that were falling. Obviously, the higher volume can be an indication of higher conviction. And so as a result of that, it actually happened twice in 3 times. And a cluster of breadth thrusts hasn't actually occurred since May 2021. And interestingly, when they've run their numbers, since 1950, the S&P 500 has risen more than twice its historic pace following such signals of this double breadth thrust. So potentially it could speak to the conviction behind the rising stocks, but obviously we'll have to wait to see how that plays out. It was an interesting indicator. I hadn't heard of that before this. The double 10 to 1 update supports the argument that the second half rally is underway. And they've got an end year forecast of 4,400, interesting, about 11% higher than it is now. How sustainable the rally is will likely depend on monetary policy, earnings, technical indicators will likely provide that information before the Fed officials or other management teams on the corporate front. Since our low in mid-June, about 5 weeks ago, S&P 500 has climbed 8%. We're out of that bear market territory and out of the crush territory on the NASDAQ. We've reclaimed the 50-day EMA, not yet the 125 or the 200-day EMA, 100 or 200-day EMA yet, but these are widely watched levels by traders. And at 36 days now, this bounce is the first one this year that's lasted more than a month. Take the wins. It's been difficult throughout this year. At times, you almost forget what sustained green periods are like. But of course, we were blessed with significant kind of atypical green periods over the past few years, so it's evened out. As happened with the last 3 recovery attempts, the more cyclically sensitive stocks, your automakers, retailers, chip makers, led the way, but past endeavours didn't end well. But what is noticeably different this time is the small cap stocks. The Russell 2000s trailed the market previously through those last bounces, the 3 that we highlighted earlier this year on that chart. But since 78, small caps have always outperformed coming out of the bear market, according to Sam Stovall. So markets always trade obviously as a forward-looking mechanism. So when small caps bottom, it historically can bode well for the broader US markets because they tend to lead the way higher as the economy strengthens. Investors still have to be cautious. They can be faked out by this easily. We know counter trend rallies are not atypical. Obviously, they're a conventional part of downwards bear markets as well. So we're still yet to see. I'd love to know your thoughts. Drop in a comment below about what you're making of it all. And then earnings sentiment as well. Forecasts for earnings have fallen, but they're still relatively elevated, especially compared to the uncertainty in the macroeconomic environment. However, JP Morgan strategists, including macroeconomic, have stated the reset in earnings expectations can actually be good because it suggests capitulation, which was what we were talking about earlier in this stream. One more thing that's fascinating as well, of course, is the Federal Reserve front-loading rate hikes as other central banks are. Obviously, the potential to front-load rate hikes is fascinating because it has the impact of demand. But the question is, are we potentially going to start hiking into weakness at some stage? And when is that weakness? Because obviously monetary policy operates with a lag. You don't immediately see the effects of it. So as a result of that, that's the difficult soft/hard landing that they're trying to toss up between them. The final thing here that we have here is we're starting to see sentiment getting more and more negative. Professional investors have been cutting risk. Flows have been interesting as well, looking at allocations. Staunchest bulls are starting to show signs of trepidation. And obviously this is all encapsulated by the fact that it could be serving as a contrarian indicator that maybe we're starting to see the worst of it or the fear of it or the uncertainty, which is something that Quincy Crosby has highlighted here. The skepticism is one reason why the market could be seen as being close to a bottom. But there's still a range of different uncertainties. And so before we discuss some of those remaining questions that we still have in the markets, some will actually be answered over this coming week with a lot of economic data prints. Some will take a few more months to be resolved and for us to get some insights surrounding. If you haven't yet, make sure you've subscribed, turn your bell notifications on. We've just dropped this for investors, the second channel, plenty of market discussions and all things economics and macro trends. So make sure you don't miss that. On the ASX Investor channel, we've been dropping a new style of video as we travel around Europe. If you haven't yet, head over and check some of those videos out. If you're wondering about the backdrop, we have just made it to Portugal at the moment. There'll be a new video coming soon in Portugal on the ASX Investor channel, but that's why we've got this backdrop. We're in an Airbnb at the moment. It's DIY set, trying to just make the most of it all and continue churning out content even as we're traveling in a remote setting. So let's look at where we're currently positioned. First and foremost, fear and greed index. We're off the bottoms in terms of sentiment. We saw some extreme fear, particularly during the sell-offs, but we're off the bottoms, definitely not into a neutral area yet, but moving towards that. Market momentum, as mentioned, below the 125-day MA, which is what CNN highlights here, still obviously below the 200-day MA as a result of that, but we've reclaimed the 50-day, which is a positive. We can see the bounce here, over 5 weeks now worth of bounce there. So it'll be fascinating to see where the momentum heads, particularly heading into earnings. Another couple of things to highlight, stock price breadth has been shot to bits. We know that there were some sectors that were performing well at the start of this year, but it's kind of been a broad-based sell-off as we've got towards the middle of the year. The question is, will there be some sectors that outperform and potentially can bring some breadth back into the market during earnings season? And then looking at the VIX as well. There was questions about whether 20 will become the new 30. Obviously, we've come back through now. We're below that 25 mark. Hopefully, we'll see volatility subside, but earnings season can always throw up some uncertainties along with that. So there's a few remaining unresolved questions that the market and economists still want to assess. First and foremost, in the near term, we're going to get some insights over the next few days. It's a busy week of economic data. Of course, the highlight will be the Federal Reserve's rate decision later on this week. 75 basis points seems to be potentially the consensus there. Will it be 50 or 75? We'll have to wait to see. On a more local front, we get Oz inflation print at the back end of this week. Euro area inflation print as well. We saw the ECB hiked rates last week, 50 basis points. And obviously this was a significant one for the first rate hike in over a decade now. But we've got that discussion about how will the central banks navigate this soft landing. They've been hiking expeditiously, basically across the board in many of the leading central banks around the world. But obviously we're starting to see some indications on the economic data front about the slowdown coming through, which is what they were aiming for. But of course, hiking into weakness is a risk and uncertainty. Where's that neutral rate? How quickly will we get there? And what happens once we do get there? And also, what will the data start to say on that inflation side? And then, of course, we're into earnings season. Earnings is going to be a big highlight. We've got the macroeconomic side, we've got the corporate front as well. This is going to be one of the biggest weeks of earnings. Nearly 1/3 of the S&P 500 is reporting. Many of your big ones, megacap technology names, you can rattle them off. Your Metas, your Apples, your Alphabets, your Amazons. 4 of the largest companies on the S&P 500 all reporting this week. Obviously, the earnings component of the valuations is going to be coming under scrutiny and question. We'll have to wait to see how it plays out. Drop in a comment. Let us know your thoughts on it all. Do you think markets have bottomed? What are you watching for? It's a fascinating time. A big thank you for joining us. Plenty more videos coming soon. For now, stay well and happy investing.